And I think that's where it gets really interesting when you start looking at the planning side. So when you understand that you've taken care of your own personal financial needs or your family's financial needs for retirement, and you realize that you might have a few $1 million that's surplus in the corporation. Well, if we die, the corporation ends up, big tax bill, and you lose a quarter of it to tax through the capital gains. Now we can take that surplus wealth, use the investment portfolio you might have in the corp that can pay the premiums on this policy, and it will compound the size of your estate and it'll flow out tax-free. So there's lots of benefits to it. When you get to larger portfolios, as soon as you hit $50,000 of passive income, you start losing the small business deduction limit. So it grinds away for every dollar over. I think it's $5 that gets eroded on the small business deduction limit. So you're going to hit that. I think a lot of by the time you're 40, you're pretty close.
Yep.
In most cases, and with that, you want to be mindful of, okay, how much more wealth, what type of investments are we holding, so we can manage that taxation a little bit to be a bit more selective about what type of income we're generating. But ultimately, the life insurance can be a great tool to fund. It grows. The par policies are growing around 6%, but tax-free, so it's closer to like 9% in your portfolio. And the volatility of these policies typically are low 2s relative to a balanced portfolio at the bank might be 12, right?
So in terms of, if we shift over to the retirement planning side of things, then what's the first thing you need to look at? Like, where do you go down the RRSP route? Do you do something fancier? What's typically that first step?
So I think early on it's RSPs, especially if you're not incorporated.
Mm-hmm.
When you're under 38 years old, 38 sort of the earliest you'd look at doing some of the other alternatives, which is like IPPs, individual pension plans. But yeah, RSPs I think at first. I am a big believer of, right now you would probably want to start off with a first home savings account. So you get the deduction, you can use it for a deposit on a home, tax-free savings account because it gives you, optionality and access to cash without any penalties or loans to be paid. So again, I'm just thinking buying a home, coming up with a down payment. So those would be the first areas I would look at. And then I think as you get yourself more, secure, maybe looking at getting incorporated, that's when we would look at, okay, are we going to just do IPP, individual pension plan?
Mm-hmm.
Gives you more funding room, but you have to make sure you're at least 38 years old, ideally 40, and that creates additional funding room that you can do over time, that you can get the deductions in the corporation. So it starts to manage some of the taxation issues that you'll start to run into too when you accumulate a lot of wealth in the corp. You can get some deductions that you can flow through and push the cost of the IPP through the corporation.
And so what is fundamentally the difference between the RRSP versus the IPP side?
Yeah, so I mean, an RSP is earned income, so you need T4 or T4A income in both cases to either do an IPP or a RSP.
Mm-hmm.
You cap out, so in 2024 your ceiling is $31,560. So basically you have to earn $175,333 in 2023 to have that kind of room in 2024.
Mm-hmm.
You don't get to put more money in. If you use up your limit, you don't create more space, I guess. The RSP will grow tax shelters, as will an IPP. The fees aren't deductible for an RSP, but for an IPP, they're deductible to the corp.
Okay.
So there are additional costs. So you have to, get every year you'll get. I have one set up for myself. It comes every January. I think it's about $1,500 to $1,600 usually. Mm-hmm. Each year to pay the actuaries for the IPP. But really, what you create in the IPP is a supersized RSP. You can contribute up to 65% more in any given year when you're older. Mm-hmm. But it starts off at 40 and it increases every year. So you can, over time, it'll compound to be a lot higher value than your RSP.
And so what's the age cutoff there? Is that like an actual, you need to be 38 or 40, you said, in order to start that account?
You don't receive the benefits of an IPP if you started earlier.
And so it's not necessarily the age, but just like having been practicing for 10 years.
It's the age.
Money.
It's just tied to
it's
tied to the age, yeah. So basically, if you assume that you're at the highest income level, say at least $200,000 of T4 income right now, if you had an RSP, you have a $31,560 contribution you can do annually. At 45, you can put $37,500 into an IPP for a net cash benefit or additional contribution of nearly $6,000. By age 55, that difference can go to as much as almost 14, and when you get to 65, it's almost 20. So it grows it exponentially, kind of over multiple years. You get to put more and more in over the RSP.
Okay, and is that because the IPP itself, the rules are getting improved in your favor, or the RRSP starts to drop off?
It's the IPP because you're trying to fund something that's going to be indexed for you for throughout retirement. They create additional funding to provide those benefits, and then there's some additional benefits that come up down the road. So if you want to retire at age 60, you can do what's called terminal funding, which you can make sure you have cost of living, indexation, all that kind of stuff. So you can put a lot more money in when you get closer to retirement on the terminal funding side. So again, and it helps to manage some of the issues you might run into with respect to corporate cash just building up. It's not that efficient in the corporate. Like you get the deduction, or you have the low tax dollars that you get to invest, so it accumulates faster, and you have that deferral. But passive income's taxed at the highest rate in the corps. So
okay.
And hence, that's where, so an IPP comes in. That's where, the corporate-owned life insurance, when you talk about later on in life, when you've taken care of those needs, you can allocate some of that money to achieving other goals that you might have.
How is an IPP actually structured then? Like, is it like an RRSP where you just put stocks and things in it? Or
you can own you can own the same sort of investments that you would own in an RRSP.
Yeah.
Some people will, from time to time, look at, I want to own my lowest returning securities or investments in there so I can create more room. So one of the unique features is that you have the ability to provide or put additional money into an IPP. So, for example, it mandates about a 7.5% rate of return. So if you only have a portfolio that generates, say, a 4.5% or 5% rate of return because you're more allocated towards fixed income in a low rate environment, you can put an additional few percent in every year to meet that obligation, so that you don't have, you keep pace with it. So, I don't know if would I necessarily do that all the time? I'm not sure it would be the first place I would start in terms of trying to manipulate my income that way, but you could do it.
Yeah. Where
you want to create more deductions.
Gotcha, okay. And so you guys are setting up IPPs for people?
Well, we actually work with actuaries, so you have to have an actuary kind of deal with that. They do the account setup, so we would do initial fact finding. We would talk to them about it and recommend it as a strategy for people where it makes sense, and then with that, you kind of go down the road of getting illustration from the actuaries. The setup, I think, takes about 3 or 4 months. I'm trying to remember what it took for myself to do it, but you have to get it all registered with CRA. So.
And in terms of the actual account and what's in there, what's the difference between who you go with? Because I know MD Financial is that an IPP that they're offering, or is that a pension plan as it's commonly thought of?
So MD Management announced, I think it was early last year, or maybe the year before. So I'm thinking it'll be 2022 or 2023 that they were going to offer a pension plan, and still trying to decipher kind of the major differences between an IPP and, I believe the plan is called Medicus with MD Management, but there are differences. An IPP is designed to kind of have maximum funding and maximum benefits, where the Medicus one, from my observation, at least early on, is that you're paying, you don't contribute more than the RSP, but some of the other benefits that are associated with an IPP are not there. The big thing in my mind, when you think about an IPP, on your death, whatever returns and contributions you've made over the years, whatever's residual is there will either go to your surviving spouse, or the benefits would keep paying your spouse, but go to your estate. Where under the Medicus plan, doesn't appear that that's the case, where you lose the ability to kind of roll that over. Now, it's taxable, no different than, say, a RRIF account would be on death, but still there's meaningful wealth that would be contributed there to the IPP over the years, or if you were in this Medicus opportunity where you'd have, if there was residual, let's say there's $500,000 or $750,000 left when you're 70, 80 years old, it just goes to the plan.
And is that how they typically work? Like when you think of teachers having one?
Yeah, so there's a common thing in the industry. It's called the 5411. So in your 54th birthday and 11th month, usually when you turn 55, you'll lose this ability to take the pension and invest it yourself. So basically, you don't do that lightly. I think you really got to look at the situation. I think you have to still do what's right. If you don't have enough money put away, maybe having someone who has a government pension that's indexed and has minimal risk to them, great. We've also seen the other side of it where you have Sears Canada, where people had pensions that were kind of hit pretty hard by it, right? So they didn't have as much there. So I think you got to evaluate it, but each situation will be unique. But sometimes you have two people, both with government jobs, with government pensions, and maybe one person decides they want to take that so they can have a larger estate to help out either kids or grandkids.
So with the pension plan, like obviously if half of it just evaporates when you die and none of it gets passed on, that's a tragic loss economically speaking. Is there a benefit to that format of, like, let's say you live to be 120? Is that kind of like the opposite gamble there of the pension plan traditionally, if you're going to live a really long time, might be safer?
Yeah, I think it really comes down to investable wealth, and this is where making that decision. If you don't have enough saved up, or you're going to be living very lean in retirement, then yeah, you want to have as much pension income that's going to be there for your life and indexed. When you have millions more than maybe you're going to spend in your lifetime, that's when you start to make these decisions, right? You have to think about, do we want to contribute to the pension plan and let the pension plan win if you don't live to be 100 years old or 95 or whatever it is. I think if it's the same thing really with when you think about CPP. When you contribute to it, it's being more and more funded like a traditional pension, but survivor benefits are pretty weak. I would say it's one of those things I think that sometime might need to be revisited or changed, because when we're making people contribute to CPP, for example, and the amounts that you do now, should there be a survivor benefit? Maybe not for higher income, but I think for mid to lower income, it would certainly be beneficial to a lot of families and widows, etc.
And so you mentioned you went down the IPP route.
Yeah.
What can you put in your IPP? Is it just like your RRSP account or any other account, or are there limits?
So if you've been paying yourself a salary for years as a physician out of your corporation, you can't be 20% or more of the holdings. And it doesn't occur to me, because I don't really have any situations I've come across where people have done that.
Nobody's
that way.
tried to do
we're
that, yeah.
generally very broadly diversified, more balanced growth type portfolio in a pension investment. So I would have to check the rules on that one, to be honest.
Okay, but you are sort of like the maker of your own destiny if you go down the IPP route. Like you can pick and choose what's in it, and
it's flexible, and the rules vary by province. But one of the nice things is if you have the income, but you might have other goals that might take priority in the short term, you can create the room that you can make the contributions in future years, and you don't necessarily have to do it in the current year. And again, it's different province by province. I know in Alberta you don't have to fund it every year, so you can let it grow a bit as a liability, and then you can fund it later on. And I think we're not the U.S. in terms of a litigious society, but it does give you some creditor protection as well. So added benefit.
Okay, there's the corporate veil, I guess, there doesn't get pierced.
Trust, yeah, it's not available to creditors.
Okay. Well, fingers crossed. I haven't been sued yet. So let's keep that streak going.
Yeah. I'm Dr. Jordan Vollrath, and you've been watching Cherry Live, brought to you by Cherry Health. Please like and subscribe to see more clips like this, or check us out at www.cherry.health, Canada's medical network.